Welcome to the Toronto Real Estate Podcast. We have a late breaking announcement today. The Bank of Canada, if you haven't heard the news, has made a 50 basis point reduction in the overnight lending rate, which is considered to be a jumbo size reduction. A lot of people were expecting this announcement, but you never really know until it actually happens. And well, it's happened. So we're going to take a deep dive into this. Today, we have Jason Friesen, who is a mortgage agent and managing partner at Outline Financial, a friend of the podcast, and none other than myself here to have this discussion a little further. My name is Ralph Fox, and I am the co-founder and broker of record of Fox Marin Associates. We are a residential real estate brokerage that focuses on central and downtown Toronto. If you have any questions or comments, please be sure to put them below. And if you like this content, please be sure to hit that like or subscribe button. Okay, Jason, let's get into it. Great to have you here this afternoon.
Thanks for having me again. 50 basis points. 4 rate cuts in a row, 125 basis points in reduction since June. Definitely positive news. We now have prime. Keep in mind, it was at 7.2% in May before the first cut, now setting at 5.95%. So for some variable rate clients, keep in mind, if you have a variable rate, you're paying below prime anywhere between 75 basis points to 100 basis points below prime. Some variable rate clients are now paying rates in the high fours. So definitely positive news. This 50 basis point cut, obviously, impacts, carrying costs for, clients with variable rates that have adjustable payments, helps pay more principal off for variable rate clients that have fixed payments. So definitely positive news. I think also the psyche of seeing a 50 basis point rate cut, even without this cut, I've started to see people moving in off the sidelines, looking to get into the market. So I assume this will further add to that.
Yeah, this is significant. This was the largest cut since the financial crisis in 2009. That's the last time we saw a 50 basis point cut. So that is really a leading indicator, I think, to what is happening in the economy. And while it's good news that rates are coming down and inflation, which came out at 1.6% below that 2% mark, is showing that, perhaps there was an over-tightening and now the bank is trying to overcompensate for that. Jason, what are your thoughts on why we've had this reduction and what that means potentially for the economy?
Sure. Seems like the economy is deteriorating. It's a tale of two economies right now. If you look at the US versus the Canadian economy, well, it seems like the US economy is pretty resilient. The Canadian economy, obviously, just looking at employment numbers, much weaker than what's going on south of the border. Seeing inflation come in below 2%, which was kind of the key driver. If inflation remained sticky, we would, not be seeing these big rate cuts, obviously. And we're also starting to see mortgage interest costs, which had a big impact on inflation overall, start to reduce quite a bit actually over the last couple of months as well. I think it's obviously positive news from a rate perspective, but obviously it's a sign of what's going on in the Canadian economy and that the Canadian economy isn't moving too well. And also, they left the door open for more rate cuts. They'll obviously continue to monitor, but their verbiage definitely opened the door. Like there will be more rate cuts. And I think the markets are pricing in rate cuts in December and January and continuing into the new year. We always track the big 6 banks forecasts, and RBC actually recently updated their forecast to 2.25% in cuts to the overnight rate by the end of next year. So the end of 2025, including this, 50 basis points. That leaves another 175 basis points in rate cuts that they're forecasting, which, and we've started to see all of the banks adjust and become a bit more aggressive in their forecasts. So, that's obviously, again, a sign of the state of the economy and where the expectations are. What I also want to talk about right now, what I'm seeing also, it's important, we saw a 50 basis point rate cut. The most common question I get with clients is, did my fixed rate go down by 50 basis points? And the answer, sadly, is no. It's important to understand that. Keep in mind that fixed rates move in anticipation of what the expectations of the central banks are, not just the Bank of Canada, but the US Fed as well. And so, while we witnessed, a 50 basis point rate cut today, bond yields were flat. They were actually up slightly. And people may ask why. fixed rates, again, are tied to bond yields, which are tied heavily to U.S. Treasuries. And we've witnessed, in the U.S. the last 3 weeks, some positive economic news. Retail sales from month to month were up. We saw big job numbers in the U.S., 100,000 more jobs or 105,000 more jobs than expected. PMI.
Yeah. Well, no, those will be revised
but
on a Friday night. On
totally.
a long week, going into a long weekend.
Tuck it in somewhere. So that doesn't.
It doesn't have anything to do that there's an election going on or anything.
Seeing these rate cuts on the variable rate side obviously have a great impact on variable rates, lines of credit, things like that, and the psyche of borrowers. But it isn't automatically translating right now into lower fixed rates. I expect that fixed rates will drift down as we continue to see rate cuts, but we're not going to see cut for cut, 50 basis points on the overnight rate, meaning a 50 basis point cut on fixed rates. Again, a lot of the expected cuts are already priced into where fixed rates are as of today. So don't expect any drastic changes. With that being said, we are seeing fixed rates firmly in like the low fours, so below 4.5% if you're looking at like a 3-year fixed or a 5-year fixed. So, fixed rates have moved down, but again, we're not seeing them move at the same pace. And there will come a point in time over the next year where variable rates will end up being lower, depending on the discount you have, than fixed rates. And so that's an important consideration for clients. And even though we try to explain this to every one of our clients, after the rate cut was announced, I had several emails from clients asking if their fixed rates went down by 50 basis points. So it's not something that is going to happen, cut for cut. Just be mindful of that if you're shopping for a mortgage. I think that's important.
Yeah, it's interesting because if you look at the historical data, variables always over a 50-year period or 100-year period outperform fixed. And I have my share of variables right now. The last couple of years were an anomaly. And I think as we return back to the norm, we'll start to see variables outperforming the fixed rates once again. But with outperformance comes risk, as a lot of people, including myself, have had to deal with over the last couple of years, which I think is really interesting. I did watch Tiff's little speech and some of his question and answers earlier today. And what I did think was interesting was he just continued to hammer home on multiple occasions that the economy has excess supply, that labor market is soft and softening. Even though we had a slight uptick last month, overall, it's up a percentage point. And it seems like they're thinking that trend line is going to continue and that inflation perceptions, both consumers and businesses, are now returning to the trend line. And so he came out on multiple times and said, we are back to low inflation and we're coming out of the other side of this, coming out of the other side of a lot of pain, which Canadians have been experiencing. And, he's saying is like, he was using the expression that, a soft landing or hard landing. He was using the expression, we need to keep on the landing. So he seems to be indicating, the bank seems to be indicating that we are on the other side of this inflationary high interest rate period and that the worst is over, which is really just refreshing to hear them say because they've been so non-committal to say anything for such a long time. And what I noticed that was really interesting from the last rate cut announcement in September was they were saying, and they signaled that their biggest worry was not inflation anymore. They're starting to become more worried about stagflation and being under that 2%, coming in at 1.6 and looking at it maybe a little more realistically. We could be heading there if we're not careful. And I think the bank is recognizing that with this cut.
I feel like the bank is kind of giving more guidance and more assurance than they have in the past. And I think a lot of Canadian consumers take homebuyers out of the equation. Just take Canadians as a whole that have obviously had a pretty rough go over the last couple of years. They're looking to, the Bank of Canada for some comments on stability and things like that. And hearing that positive news obviously goes a long way. I think, a lot of people are suffering from some pretty significant emotional damage from the last couple of years. Clients with mortgages, just cost of living as a whole. Take anyone owning a mortgage out of the equation. And again, just look at grocery costs and things like that. People are looking to have some assurances that the worst are behind us. Yeah, I think that's important that they have changed their tone. And
even if you're taking mortgages out of the equation, you're adding in rent.
Exactly.
So, I mean, you've got to pay to live somewhere, theoretically.
Totally.
So it's so interesting because we are very much in doing what we do on the front line of people's emotional well-being, and generally when they need to make or feel they need to make a change, either positive or negative, either because they're doing well financially or poorly financially, we're usually one of the first phone calls. We often know that someone's pregnant before their parents do sometimes. But in the last year to year and a half, the amount of divorces, state litigations, receivership, like the amount of like stressed situations, not necessarily people selling because banks are forcing them to sell, but just a lot of people being in a lot of stress being manifested through constrained lifestyle and news cycles. It's been really, really tough on a lot of people psychologically and psychically as a result of this economic climate. I don't think a lot of people really understand that, but we're seeing it on a day-to-day basis.
I'm seeing that a lot also with like investor clients who probably, they bought, a condo or bought a place in the last 4 or 5 years. Either they're faced with a much higher renewal, or the possibility of, and then carrying costs going up, or just the reality of life changing and life costing more and people being in different financial situations that, they're looking to sell those properties and tap into some of the equity. And what's going on with rental rates right now? Are they flat? Are they up? Are they down? I haven't followed rental prices as much as
we're starting to see it cool off.
Is there more demand? More supply right now?
Yeah, and I think a lot more people are staying at home or staying put. I mean, it's just so crazy when you think about it. $75,000, $80,000 just out of school, and that qualifies you for a 1-bedroom.
Yeah,
and
if you're lucky.
And there are people in that position that are going to food banks just to try and make it to the end of the month. I was just speaking with somebody earlier. They make $250,000 a year and live relatively modestly. And at the end of the month, at the end of the year, they have nothing left.
Do you remember when we walked in and had a coffee a couple months ago along College Street? We went to, which we found out after was a food bank, and it was like the most diverse, like all walks of life. I thought they were lining up for concert tickets. I'm being serious. Like it did not, kind of meet what you would expect would be a lineup for a food bank. And it was shocking and surprising. And the lineup was extremely long. And it was young people, old people. It was quite alarming. It actually took both of us back when we were walking by it and realized what it was.
I saw on Twitter someone was reposting that a potato farmer was getting rid of their excess damaged potatoes, and 1,500 people, 2,000 people showed up for these free potatoes. It didn't even look and feel like Canada. So there are a lot of people that are hurting and a lot of people struggling to get by.
Totally.
And you combine that with incredibly high taxes, and that's something that's not included in inflation. Be interesting. Oh, our property taxes are up 9% this year. Oh, the government has increased this hidden tax in gasoline this year. You add up all of these taxes. Taxes are very inflationary in and of itself, and it's not even calculated because I don't think they want people to see how much we're actually paying in total on taxes at all levels.
I think when you look at like the annual house, like the average household income in the GTA, it's alarming. It's crazy to think that a family of 4, I don't know where it is. It's definitely well south of 100,000. I have no idea what that number is. Maybe in the 70s. I could be wrong. But when you look at a household income, like it's crazy to think about, how much food prices have gone up and rent prices have gone up and how people are struggling. It's no surprise that you're seeing lineups at food banks and people lining up for free potatoes. Like it's crazy. Yeah. People are completely stretched to the max.
And you have double income families with no kids still struggling, where in the 70s, you could have one person working and a family of 4 or 5 in a detached home. And
Totally.
so, I don't think we want to get me going on currency debasement and money printing and excessive monetary debt on this
I've heard it before.
conversation.
I've heard it before from you.
But it's put us in a pretty difficult place, and I think it's only going to get worse, unfortunately. The other thing is that the wealthy are continuing to get wealthy.
Totally. It seems
Hard
like there's an
assets.
erosion of like the middle class, sadly.
I don't know how we ended up here talking about a 50 basis point reduction, but it
just
does
overall
seem like
state of the Canadian economy and where things are at, right? And
I
how
think
we got
the way
here.
people are thinking and feeling.
Yeah.
But the messaging from the Bank of Canada was much more committal and much more decisive in terms of it talking about the pain, the worst being over and things starting to ease up and more rate cuts to come. It was far more positive. It was far more committal than we've heard for a very, very long time. And I look forward to the day where I no longer have these Bank of Canada announcements saved to my calendar because it used to be that these were just non-starters. I never used to have that ever, having been in real estate for a very long time. And it's only in the last 2 years that we actually have been watching every word that, the governor of the Bank of Canada has been stating.
I'm curious what this will do for the psyche of potential buyers as well. If it will bring people off of the sidelines. You and I talked about before, I've witnessed quite a big pickup in people reaching out and people making offers and people purchasing homes. And part of that, we have these mortgage rule changes coming into place that as of December 15th, which are going to basically, I'll just recap what they are. So currently, if you have less than 20%, you're capped below a purchase price of $1 million. That's being increased to below 1.5 million. And also for first-time buyers are able to now go with a 30 versus a 25-year if they are a CMHC. So again, if you had less than 20%, you were capped at a 25-year amortization, and now you're able to go with a 30-year. That gives about a 10% increase in purchasing power. So it's pretty significant. And so I have a lot of buyers that are in a situation right now that, they have a solid down payment, they have all of their ducks in a row, and they're looking to purchase before we see more demand in that price point. It's typically, if I look at the 900 to 1.3 or 1.4 range of the market for single family homes, it typically is like, the middle of the market seems to be the hottest area of the market. A two-income household can afford that. Maybe they're selling their first place. Maybe they've got a down payment they've saved up. They're getting family help. And so, what we are doing is adding more demand into that segment of the market. And we've not really done anything to address supply at any point in time. I have a lot of clients that are looking at this as an opportunity where, if we wait until the spring, it will likely mean prices are up, combination of rates going down. If you look, there's direct inverse correlation between rates going up, prices going, when prices go up, it's because rates are down and vice versa. So I think we've got a lot of people that are looking to get in now before we potentially see, an increase 100%. In the market again.
Well, we're already seeing it. And one of the agents on our team has clients looking on the West End and they're capped at just under 1.2. And what they were looking for and have offered on multiple times is now that category or caliber of property is now out of reach. And so what is interesting, though, is that I do think that first-time entry-level, first-time buyer freehold property is really picking up on demand. And we're seeing multiple offers across the board in that bracket. And what you'll see is, in my opinion, is once that becomes completely out of reach for most buyers, that's going to push them down just because of straight affordability into the condo market. And that will start to be the rebound of the condo market. And typically the condo market tends to catch on fire when you have first-time buyers or buyers who can no longer get into the housing market.
When that spread increases between...
That gap gets so wide, they get forced into the two bedrooms and those type of properties because they're like, well, that's going to be the next asset class to go, which will be the larger 2-bedroom, 2.5-bedroom condos. And that's what I think we'll start to see catch on in the spring. But I do agree with what you were saying earlier. And again, I try not to get too political on these podcasts, but it just blows my mind how our Minister of Finance, who is formerly a journalist, not that there's anything wrong with being a journalist, but I'm just saying when you start to listen to some of her commentary in introducing this new policy, somehow she was equating this new policy to creating more supply, which is just absurd. And essentially what it's going to do is just further drive demand. And it's going to further hurt affordability where affordability is needed most in that price range, which is really unfortunate. It's going to be very helpful to the overall housing market, and maybe whoever wrote that policy clearly had the understanding to know that that might be a way of helping to support the condo market, which I think it's really doing. And it's doing nothing for resale because you need to put down over 20% for pre-construction. Sorry, it's doing nothing for because you need to put in over 20%. It almost is a way of starting to backstop and drive more demand into the condo market 3 to 6 months down the road. But if you're in that position that you were talking about of a first-time buyer, now is an ideal time to get into that because it will be out of reach really quickly.
Especially if you don't have a place to sell. Like if you're a first-time buyer, you've got cash, you've got, you're ready to go, you're able to move quickly. And those are the buyers that I'm seeing that are striking right now.
You're the apex. If you're a buyer in Toronto real estate and you don't have to sell and you are qualified and you have cash in hand, you are the apex predator of the Toronto real estate market at the moment. Because the problem that we have right now is most people need to sell before they buy. And if they're in a condo and they're needing to move from their condo into that first freehold property, which is what we have called the property ladder to some, others try and just skip it, but there is a property ladder here in Toronto. They're stuck in their condos right now because they're unable to sell at the prices that they need in order to be able to move into freehold.
Are you seeing any activity like in condos, like are 2-bedroom, like large? Yeah,
larger condos, unique properties, larger condos are selling, but we're over 7 months of inventory in condos in central and downtown Toronto, which is putting a lot of duress on the market. However, shockingly, year over year, prices are only 3% lower. And that's because nobody is a forced seller. And you have a lot of rented properties where if a landlord can get his price, great. And if not, he'll just keep taking rents at a loss. And if he's at a variable, he'll be 50 basis points lower at the end of this month.
And maybe it makes sense to lock into a fixed rate if they continue to drop as well, increase your cash flow. And when you talk about that 7 months of inventory, is the makeup primarily of a large amount of those condos like investor driven? What does that look like? What are you seeing?
I've seen stats like 30 to 40% are tenanted.
Wow.
Significant portion are tenanted. And the properties that are selling are the good properties, the good condos, the livable ones, the good floor plans, good locations. And part of the problem is that a lot of people, when they bought or invested in a pre-construction condo, they bought off plan and they weren't really thinking about what a 3-bedroom, 600 square foot condo would look like because it filled up the page pretty big and they had no theory of relevance and they weren't getting really good guidance from whoever was working with them or for them. And so they ended up buying these properties that are somewhat unlivable. So the bad layouts, those are the ones that are sitting. The tenanted properties, those are the ones that are sitting. But empty, vacant, staged, larger size condos are the ones that are moving. And I think they're going to be the first ones to fly off the shelf once we see the real effects of these policy changes coming into effect in December.
So it's clearly, obviously shifted towards being a buyer's market. So buyers are being more, kind of picky on what they're looking to purchase on the condo side.
On the condo side. Yeah. Low rise, a little different. And how are you advising clients? Like if you were to buy a property today, now knowing what you know about the economy in the market, would you go variable or fixed?
Depends on the risk tolerance. It's not a one-size-fits-all approach.
I'm talking about you. Yeah. You're buying, what would you do?
I'd probably take a variable rate.
Yeah.
Yeah. And, I would take the variable rate, not because I plan on locking it in, but because I do know that the math has shown over the last 20 years, last couple of years excluded, that a variable rate has put a consumer out on top. Totally.
I think you have a couple of variables as well.
I would probably go with a variable rate. I am a long-term believer in variable rates, but I appreciate, for clients making this decision, even with rates coming down, payments and monthly payments are a big factor. And if you take a variable rate, you're starting out at a much higher payment than you are with a fixed rate. And that plays into a lot of clients' decision making. And then there's just people that are not, risk takers, and they have emotional scars because of what's happened over the course of the last couple of years as well, right? So they'll take a fixed rate, or, they'll go short-term fixed. Most clients, I would say, are short-term fixed or variable. I have very, very, very few clients looking at like longer than 3 years if they're taking a fixed rate. Two reasons for that. One is that the expectation is that rates will come down. And then the second part of that is that penalties are much greater for the longer fixed rate mortgages. So longer term fixed rates will, you get into what's called an interest rate differential, or the term IRD. But if we look at it from just using round numbers, say your mortgage is 5%, that's your interest rate, and it's a 5-year term, and 2 years in, you go to break the mortgage. So you have 3 years remaining. Say the bank looks at it and says, well, we thought we had 5% for the next 5 years. 2 years in, we want to break it. Now we can only get 3%. Say rates have dropped that much. They'll collect that 2% difference in interest from you, multiplied by your mortgage balance, multiplied by the number of years remaining. So you could have a penalty that's $30,000, $40,000, $50,000 if rates drop substantially. So there's obviously a risk that rates don't drop and that they have bottomed out and they don't go down any further. And, that's a risk that you would take by going shorter term versus longer term. But a lot of clients are willing to do that because they do think that they'll find themselves in a better spot in the next couple of years.
And what do you think will happen in December?
A 1/4 point cut as it stands right now. Maybe we'll see if there's another 50 basis points. I think we'll have to see how the next, the November, if we look in November and see the October numbers for jobs, inflation, all that kind of stuff, that will obviously have an impact.
Yeah, I think a 1/4 basis point is the safe answer, but who knows? There could be a civil war November 6th down south.
Yeah, absolutely.
So that might affect lending rates as well. Okay, Jason, is there anything else you'd like to add or any color you'd like to give on what you're seeing right now?
No, I think it's just, if you're entering into the market, as I always suggest, just make sure you stick to a budget and make sure you always start by going through your mortgage numbers and not only finding out how much you qualify for, but working with a mortgage advisor that's going to work through a budget to make sure that the mortgage fits into your financial plan. Make sure you're factoring in any potential life changes, whether that be, starting a family, childcare costs, things like that. But I think now is the time, with there still being some uncertainty, even though we are past the worst of it, to be conservative. I don't think now is the time to take huge risks. So that's really it. That's really it. Just stick to your budget and know your numbers before you go out and start looking at places. Because if you go out and start looking at places, you are going to find a way to justify why you should spend more money than you should on a place, right? So that's it.
People buy on emotion and then justify with logic afterwards.
Totally.
You don't want to be that person, which is why we always want someone to speak to you before they speak to us, so then we know what we're reasonably looking at. Jason, where can people find you?
Outline.ca, www.outline.ca, jason.friesen at outline.ca. That's JASON.FRIESEN at outline.ca. You can follow Outline on Instagram. We have a great app in the App Store if you want to look at monthly payments, closing costs, things like that. And
Awesome. Jason, thank you so much for joining us. To our viewers, thank you so much for sticking with us to the end of this conversation. We hope you found it interesting and somewhat insightful in this never-ending, changing interest rate, inflation, real estate, economic environment that we are in, which is always ever evolving. My name is Ralph Fox. Thank you so much for tuning in to the Toronto Real Estate Podcast. And if you have any comments, we'd absolutely love to hear from you down below. And please be sure to hit that like or subscribe button, and we will see you on the flip side.
Thanks
for tuning in.